Welcome to another deep dive. Today we're taking a look at, well, a pretty dynamic 24-hour period in global business news. We're pulling out the most important insights you need to be truly well-informed.
Indeed. And our sources today, they paint a really diverse picture. You've got struggles within the UK's building sector, then the expanding ripple effects of international trade policies, and, a whole flurry of major corporate earnings. It's definitely a busy landscape out there, lots of interconnected pieces.
Absolutely. And that's what we're here to unpack. Our mission today is to highlight the key economic indicators, those significant policy decisions, and the surprising corporate wins and losses. Show you how they all connect. Think of this as your shortcut to understanding the forces shaping today's global economy, hopefully giving you that aha moment.
Exactly. We'll focus on the what's and, maybe more importantly, the why it matters, helping you spot the underlying patterns in what might just seem like, separate headlines otherwise.
Okay, let's kick things off then. Let's zoom in on the UK construction sector. The latest numbers paint a rather challenging picture. What's going on here?
Yeah, what's particularly striking is that activity, UK construction activity. It's fallen at its fastest rate in over 5 years.
Wow.
Specifically, since May 2020, during the first COVID-19 lockdown, S&P Global reported what they called a considerable slump for July.
That's a significant drop, not just a blip. And the sources explicitly link this to a really pressing issue for the UK, don't they?
Precisely. This data indicates the government is, really struggling to hit its house building targets, particularly thinking about Labour's goal building 1.5 million new homes by 2029. The sharpest fall was actually in residential building, but commercial construction and civil engineering, they also saw contractions in July.
Right, and we have a specific number from S&P Global's Purchasing Managers Index, the PMI. For those maybe not familiar, what does that index really tell us, and what was the July reading?
So the S&P Global UK Construction PMI, it dropped to 44.3 in July. That's down from 48.8 in June. And remember, any reading below 50, that indicates a contraction in activity.
Okay.
So 44.3 signals the sharpest contraction in, over 5 years. It's a key gauge, really, of the economic health in that sector.
So the builders themselves, what did they point to? What were the primary causes for this downturn, in their view?
They largely attributed it to ongoing site delays, first off, then lower volumes of incoming new business, and also a noticeable weakening of customer confidence. You can see why. Joe Hayes, he's the principal economist at S&P Global Market Intelligence. He described it as a fresh setback. He highlighted that sharp drop in residential building and an accelerated fall in civil engineering projects. And he also noted that constructors are, clearly preparing for challenging times. You see that in reduced material purchases and staff reductions, too.
That definitely prompts an important question then. Given these figures, what do the experts predict for the future here for UK construction? Are we looking at a prolonged slump, or is recovery somewhere on the horizon?
Well, opinions are a bit mixed, but there's maybe a cautious lean towards recovery. Elliot Jordan Doak of Pantheon Macroeconomics, for instance, he predicts the PMI should rebound. He cites a likely Bank of England interest rate cut in August that would ease borrowing costs.
Right.
He also points to maybe a fading shock from tariff uncertainty and the government's focus on investment spending and planning reforms as potential supports down the line.
Okay, but not everyone shares that immediate optimism, I take it. What's the other side of that coin?
That's right. Gareth Belsham, he's from Bloom Building Consultancy, called the data tough to swallow. Harsh words. He emphasized that all 3 subsectors contracted, not just one. And he noted new order numbers have fallen for 7 months straight, July being the worst month since February. That reflects weak contractor confidence, and it's leading to layoffs. Then you have Brian Smith from AECOM highlighting it's the 7th consecutive month of declining activity, underscores deep caution.
7 months.
Yeah. Now, he did welcome the new infrastructure pipeline, 780 projects worth $530 billion. That gives some long-term certainty. But he stressed these can't be delivered without tackling persistent labor shortages, especially technical and delivery roles.
That old chestnut.
Exactly. On a slightly brighter note, Max Jones of Lloyd's offered a more optimistic outlook. He sees signs of recovery as easing inflation starts to stabilize material costs, things like steel, concrete, aggregates. That could improve supply chains and maybe project delivery timelines. So a bit of hope there.
Okay, let's shift gears. Moving from those domestic indicators, a really significant and interconnected theme emerging from our sources is the global impact of Donald Trump's ongoing trade policies. And this impact is being felt across continents, across industries. Let's start with India.
Right. So connecting this to the broader geopolitical landscape, the White House has imposed an additional 25% tariff on imports from India. This brings the total tariffs on certain goods up to, well, 50%.
50%, wow. What's the underlying reason given for such an aggressive move?
It's explicitly stated as retaliation. Retaliation for India's direct or indirect purchases of Russian oil, and the executive order signed by Trump. It also includes a provision that other countries importing Russian oil could face similar 25% ad valorem tariffs.
Okay, so based on value.
Exactly. A percentage of the goods value, not their quantity.
Now, what are the immediate predicted consequences of this, particularly for India?
Well, analyst John Kickleiter predicts this will inevitably drive up crude oil costs, creates, in his words, a burden on India's economy. Makes sense. And you saw the iShares MSCI India ETF, which tracks Indian equities. It dropped by 0.5% today, reacting to this tariff news.
A direct market reaction.
Yep. And it's worth noting the timing, too. This executive order came shortly after U.S. envoy Steve Witkoff met President Putin in Moscow. Interesting context.
And it's not just India feeling the heat, is it? Pharmaceutical companies, especially over in Europe, they're also on edge.
Exactly right. European pharmaceutical stocks, measured by the STOXX Healthcare Index, they've sunk to a near 4-month low, dropped 1.6% today alone. And this is directly tied to Trump repeating threats about introducing tariffs on drug imports.
Right, I saw that.
Yeah, he's discussed starting with a, quote, small tariff before escalating it, potentially 150% within 18 months, and maybe even 250% eventually, all framed, as an effort to boost domestic production in the U.S.
Those are just staggering figures, a potential 250% tariff. How are European drug makers reacting to that kind of threat?
Well, you see companies like Germany's Bayer, for example. Their stock was down 4.7% today. That came after they reported a 5.1% drop in first-half earnings anyway, so it just compounds the concerns.
Double whammy.
Pretty much. And the European pharmaceutical industry as a whole warned last month that even a 15% tariff, just 15%, on EU-imported medicines would cause significant harm to patients, both sides of the Atlantic, suggesting, a much larger tariff would be potentially catastrophic.
And these trade policies, they're clearly impacting major global corporations directly. Honda seems like a really stark illustration here.
Yeah, this raises that important question, doesn't it? How do these tariffs directly translate to company performance? Honda Motor reported a dramatic 50% drop in quarterly profits, half, down to 244 billion yen, or about 1.2 billion.
50%.
And a significant chunk of that, 124 billion yen, was a direct hit from these tariffs. Then there was another 113 billion yen in losses attributed to electric car sales in the U.S., presumably linked to related trade policies, maybe competition dynamics. But yeah, this figure from Honda, it's not just some corporate hiccup. It vividly shows how quickly these geopolitical trade policies can just erode profitability, forces even huge global players to fundamentally rethink, their supply chain resilience, their market strategies. Everything.
Okay, let's step back a bit from specific sectors.
Yeah.
What's the broader economic sentiment, particularly in the U.S. with all this volatility?
Well, Neil Kashkari, he's the president of the Federal Reserve Bank of Minneapolis. He suggested it might soon be appropriate to start cutting U.S. interest rates, noting the economy is showing signs of slowing down. He argued it might actually be better for the FOMC, the Fed policymakers, to act sooner rather than later, instead of waiting for the full impact of Trump's trade policies to become clearer, even if it means, adjusting course later on. Now, the Fed's FOMC, they left rates on hold back in July, but recent job creation data, it has indeed been weaker than people previously thought, so maybe he has a point.
Right. Meanwhile, how's the UK stock market holding up amidst all these global trade concerns?
Well, surprisingly perhaps, despite all the ongoing trade war developments, the UK's Footsie 100 index actually ended the day at a new closing high, reached 900 and 164 points, up 0.24%, still below its intraday high, mind you, but a positive closing peak shows some resilience.
Who are the big risers?
Top risers included insurer Hiscox, precious metals producer Fresnillo, drinks firm Diageo, and the energy giant BP. A mixed bag.
Okay, now let's turn our attention to some significant corporate updates from our sources, highlighting the pretty diverse landscape of business performance right now. What's the latest with Apple?
Well, White House economic advisor Kevin Hassett hinted that Apple would announce a $100 billion domestic manufacturing pledge today, specifically focusing on bringing more manufacturing back to the United States.
$100 billion.
Yeah, it's a new financial commitment. It follows Apple's previous pledge back in February. Remember, they pledged to invest $500 billion in the U.S. over 4 years, which included that giant factory in Texas for AI servers. So this is another step, definitely aligns with those broader policy goals of reshoring manufacturing.
And Uber also made a pretty significant announcement. Sounds like it reflects strong confidence in their operations.
Yes, very much so. Uber announced a substantial $20 billion share buyback program. That came after reporting really impressive revenue growth, their gross bookings, up 17% year on year, hit $46.8 billion.
Wow.
And income from operations surged 82% to $1.5 billion. Their trailing 12-month free cash flow hit a new high, too, $8.5 billion. So yeah, signals significant financial health. And they're returning cash to shareholders.
Okay. And a rather surprising success story, maybe in the fast food world,
Yeah.
given the economic backdrop.
Yeah, McDonald's. They managed to shrug off that broader economic anxiety, posted a 3.8% rise in global comparable sales in the April-June quarter. And this included broad-based growth, U.S. sales up 2.5%, overseas sales up 4%.
Pretty solid.
Very. And this performance, it notably ended 4 quarters of kind of weaker growth for them. They had been affected by that E. coli outbreak, some backlash against American brands in the Middle East, and just general consumer unease over the economy, partly due to those trade disputes. So their ability to recover suggests, strong brand loyalty, maybe adaptable strategies.
But on the flip side, some major brands are facing really serious challenges, like Claire's Accessories.
Yeah, Claire's Accessories faces a pretty uncertain future on UK high streets. Its U.S. parent business filed for Chapter 11 bankruptcy in Delaware.
Chapter 11. So, reorganization.
Typically, yeah. It allows a company to try and reorganize its finances and keep operating under court protection. But this is the second time the group's declared bankruptcy. The first was back in 2018.
Wow.
The company's been pressured by weak consumer demand, supply chain uncertainty, the usual suspects. Now, its 280 UK stores are currently unaffected, they say, but advisors have been hired to find a buyer for the British operations, and that could ultimately lead to significant store closures down the road.
Okay. Disney, another global household name, they also had earnings out. How did they perform?
Disney actually beat Wall Street expectations. They had a 16% rise in adjusted earnings per share to $1.61. Revenues increased 2% up to $23.7 billion. Income before taxes rose 4% to $3.2 billion. So pretty good on the surface.
Sounds decent. Where did the growth come from?
Well, income from experiences, that's their theme parks, was up significantly. It hit $2.5 billion. And sports, basically ESPN, also rose to $1 billion. However, income from entertainment, which includes Disney Plus and Hulu streaming, that actually fell by $179 million, down to $1 billion.
So streaming's still a challenge.
Suggests the streaming division still faces those profitability challenges, yeah. CEO Bob Iger expressed satisfaction overall, though. Mentioned upcoming developments like ESPN's direct-to-consumer service and the Hulu Disney Plus integration as key future drivers.
Right. And then a significant dip for a major pharmaceutical company, Novo Nordisk. What happened there?
Novo Nordisk, yeah, widely known for its injectable diabetes drugs like Ozempic. They saw sales slow sharply. Why? Fierce competition, plus that looming threat of U.S. tariffs we talked about. The company had to cut its full-year sales forecast. That led to a nearly $100 billion loss in market value. Huge.
$100 billion. Just wiped off.
Pretty much. Its share price slid 30% in its worst week